So, what's the agenda for this talk? It's pretty straightforward. First off, we're going to talk about the origins of SOX and why we needed it. Basically, it comes from the Enron and WorldCom scandals. Then we're going to move into certification and auditing. We know these as sections 302 and 906 of SOX. After we're done with auditing, we're going to talk about auditor independence and disclosure. We're going to relate this to section 409. And last but not least, we're going to talk about whistleblowing, which is section 806. Before we hop into the discussion, let's cover just a bit of brief history. The Sarbanes-Oxley Act, also known as SOX, emerged when Enron and WorldCom committed massive frauds involving their accounting. They defrauded people like you would not believe and caused a major market collapse. Lots of people lost a lot of money, pretty much everyone lost everything, and it destroyed investor confidence in the US market. People looked at the US market and said, I ain't put my money there. What companies tell you is a lie. Well, what happened is Congress responded. Congress, a whole bunch of people actually in Congress, including Sarbanes and Oxley, penned a law called SOX. And what this law did was provide the guidelines on how to report in a transparent fashion as a company to stakeholders and stockholders and the general public outside of the company. This solution was pretty well thought out, and it worked for a long time. It even still works a bit nowadays. Companies may complain that it's expensive to report, but that's the cost of being transparent. And that's also the cost of being on a public exchange. If you want to sell stock and you want to have people fund your company, you're going to have to follow SOX. Before SOX, life was interesting. There was no personal liability for misstatements or omissions or errors in publicly facing documents such as a PR or a Form 13G or a 10K or Q showing financial health of the company. Basically, what would happen is that they published a form and everyone just assumed that, hey, the auditor made sure it was okay, which usually wasn't the case. So what happened is people would make investments on this erroneous information, things would go bad, and when the CEO went to court to, argue their case and stay out of jail, they basically said, well, I just didn't know. So how am I responsible for something I didn't know? And the court couldn't hold him to that, because there's no law saying, well, yeah, you were responsible, but you didn't know, so we have to let you go. That didn't settle well with the market or investors. That made everything very uncertain. It also allowed execs to basically fleece people of investments with really no ramifications. So when they wrote up SOX, they sat down and said, how can we make sure this doesn't happen or happens a lot less? What they said was this, is, okay, whenever something gets published, a compliance document, a filing, or whatever, the CFO and CEO, or one or the other, sometimes both, will sign off saying, everything in here is true. There is no untrue statements in this document or whatever it is. And if we report any numbers, they are a fair statement of the financial health of the company. There's no lies. So 302 of the SOX Act forced personal liability onto the C-suite when it comes to making statements like this. And we call that certification. Now, before we hop into the next slide, we need to define one fancy term used in accounting called internal control. Internal controls are just the process of which executives or somebody in the company assures the public of the reliability and preparation of financial statements for their consumption. For example, the CEO has to sign off using a process on this document saying everything in here is correct. Therefore, we can share it with the public and they can make informed decisions, informed investments using that document. That process leading to eventual certification involving the C-level people, the auditors, people working in the company, all sorts of legal teams and other things like that is called internal control. Life before SOX was kind of interesting. Every company had to file audited financials with the SEC, which is fine. And the accountants or the auditors made sure those numbers were correct. However, there was no audit or understanding of the processes leading up to those numbers. For example, the recognition of revenue, which would influence the numbers. How to recognize whether to see a receipt this year or next year. Things like that. Internal processes were not very well understood, scrutinized, or even audited to know whether they were doing what they're supposed to do. So, when SOX came along, it changed all that. Section 404 of SOX demands proper audited financials and audits of internal controls. The audited team goes in, they make sure the numbers are good, then they publish a paper or report about the internal controls of the company. And it's done in a very independent and external way to increase transparency into how the company works, recognizes revenue, and other things that investors would care about. You may have noticed I emphasized the word independent or independence last frame. Why? When it gets down to it, in the past, accountants were paid consultants. Their paychecks were proportional to how well the business was doing. So if they padded the numbers or misreported numbers as to make the business look better than it was, their paycheck increased. That's a conflict of interest. So SOX said, no, that stops here. You can no longer be a consultant, and your pay cannot be dependent upon company performance. Rather, you're going to operate as an external agent that gets hired. You're going to go into the facility or business or whatever it is, do an objective and fair accounting of their numbers and their internal controls and report. So SOX ended up basically terminating the idea that accountants could be consultants. Also, SOX created what we call the PCAOB, or the Public Company Accounting Oversight Board. This board is fairly complex, and what it does is it regulates accountants' behaviors. They look at each accounting firm and each individual accountant. They determine whether the accountant and